Give it away, give it away, give it away now. Give it away, give it away, give it away.
And now, a look at the infamous big bank bailout. By the numbers. According to documents released through the Freedom of Information Act and published by Bloomberg Markets magazine in its upcoming January issue, the bailout was far bigger than the Federal Reserve let the public or even members of Congress know at the time. In fact, from the start of the financial crisis in 2007 through March of 2009, the Fed loaned or guaranteed the banks some $7.7 trillion, about half the value of all the goods and services produced by the U.S. economy. That's 11 times the $700 billion in aid provided by the Treasury Department's better-known Troubled Asset Relief Program, or TARP. On just one day, December 5th, 2008, America's banks borrowed $1.2 trillion from the Fed. Furthermore, says Bloomberg, the banks borrowed that money from the Fed at as little as 1/100 of 1% interest. As a result, the banks were spared the need of selling off assets that paid much higher rates of interest. Bloomberg estimates the banks made a $13 billion profit on the spread on money they borrowed virtually free from the Fed. Bottom line, the nation's sixth largest banks saw their assets grow by 39% from September of 2006 to September of this year, from $6.8 trillion then to $9.5 trillion now. For its part, the Fed says its loans to the banks were all backed by collateral, and that almost all of the loans have now been repaid.